Imagine a world where the lifeblood of the economy flows smoothly, regulated by a complex web of laws and regulations.
That sounds intriguing. But how exactly does financial law play into that?
Financial law governs everything from commercial banking to capital markets and insurance. It's the backbone of our financial system.
Indeed, it's not just about regulations. Financial law shapes the relationships and transactions between market participants, ensuring stability and consumer protection.
So it's a mixture of public and private law encompassing various financial industries.
Exactly. Financial law is a crucial part of commercial law, but is more focused on financial transactions and markets.
Wow, how does one even begin to understand its complexities?
Financial law consists of three main pillars: market practices, case law, and regulation. Each plays a significant role in shaping the financial landscape.
And let's not forget the legal concepts that underpin these pillars, which create a framework for categorizing financial instruments.
It's like a chess game, then, where every player must stand both the rules and the strategies.
Well said. And as we dive deeper, we'll uncover more intricate details. Let's explore these three pillars further. To kick things off, the first pillar is market practices.
So how do these market practices influence financial law?
They create norms and standards that parties self-regulate under. When these norms are challenged, legal rules emerge from disputes.
Exactly. The interaction between market practices and legal interpretations is fascinating.
But what happens when the expectations set by these practices are violated?
That's where case law comes into play, allowing courts to shape the law by interpreting these practices in light of commercial realities.
So does this mean that litigation can actually help establish norms in financial law?
You could definitely say that. Disputes often reflect market realities and can either reinforce or reshape legal frameworks.
Market practices are crucial in setting the foundation for financial transactions, particularly in England and Wales.
Interesting. What do you mean by soft law here?
Soft law refers to voluntary standards and practices shaped by market participants. They can define relationships, but may not have formal legal weight.
Yes, soft law plays a significant role, especially in areas where common law creates uncertainty.
But could reliance on soft law backfire, especially for consumer protection?
Absolutely, which is why some argue that a balance must be struck to avoid over-reliance on these norms.
I've heard about the surge in credit derivatives. Was that influenced by soft law?
Yes, the robust opinion of legal experts helped the market thrive despite existing restrictions.
It's a fascinating case of how legal interpretation can lead to innovative financial products.
So is soft law really just a stepping stone toward hard law?
In many instances, yes, experienced practice can lead to soft law evolving into formal regulations. Now let's pivot to the second pillar, case law.
How does case law influence financial law?
Case law reflects a pragmatic interpretation of market practices, often aiming for commercially beneficial outcomes.
It's an iterative process. Courts strive to facilitate market transactions while maintaining the autonomy of parties involved.
What about when courts go against established norms?
There are exceptions, like in the famous case of BCCI, where the court validated non-traditional financial practices despite conceptual challenges.
Exactly. Courts are wary of labeling practices as impossible, as doing so would hinder market development.
But it sounds like this system can lead to uneven coverage in financial disputes.
Correct, as many participants prefer arbitration over litigation, which can lead to gaps in legal precedents.
Yet there's a silver lining. As seen post-2008 crisis, new litigious entities like hedge funds have emerged, pushing case law forward despite these challenges.
It's fascinating to see how crises can propel legal evolution.
Finally, we arrive at the third pillar, regulation and legislation.
What's the primary role of regulation in financial markets?
Regulations set explicit rules governing financial services, with frameworks shaped by national and international bodies.
The balance between arm's-length fiduciary and consumerist approaches is critical. They govern how financial relationships operate.
Can you give me examples of these regulations in action?
Sure. MiFID II and various payment services directives are great examples that emerged after the financial crisis to regulate trading practices.
Alongside these are the Financial Conduct Authority regulations, ensuring better governance in market conduct.
That sounds comprehensive, but not everything has been perfectly aligned with existing practices, right?
Correct, as demonstrated in the INRI Lehman Brothers case, where the intent behind regulations faced scrutiny.
So, with such complexity, how does an international project like the Geneva Securities Convention even function?
Interesting you mentioned that. It's a framework attempting harmonization, but has seen limited success due to lack of widespread adoption.
That's rather surprising.
It is. The challenge of aligning global markets with rigid regulations continues to be an evolving landscape.
I can't help but wonder how our listeners perceive these complex topics. If any know more about ongoing regulations or international agreements, please share your thoughts in the comments below.
Yes, interactivity is key. We'd love to hear your insights.
With that, we've unveiled the intricate layers of financial law. The story continues to evolve, with more chapters yet to come. Stay tuned.